Today, June the 3rd, 2023, I was going through some old video files. And as I've stated from time to time in this series, this playlist, whatever, that I've been selling covered options for a long time. And so I'm going to just throw together some videos I took. These were in 1911 or 10 and 1911, so a good while back. And it was recorded with what was state-of-the-art equipment, at least from on my budget, it was state-of-the-art. So the video quality is very poor, although would be looking at a younger face. But anyway, there's some information there, and you might find it interesting, just sort of a flashback to what I was doing back in 2010, 2011. So here we go. What is an option? An option is like an insurance policy. People buy options in order to lock in the option to buy or sell a stock at a particular point in time at a particular price. So the particular time is called the expiration date of the option, and the particular price is called the striking price. So people buy options usually either for one of two purposes. Either speculation, they believe the market is going to move rapidly one way or another, or a particular stock that they're buying the option in is going to move one way or the other rapidly, and they want to, for the least amount of money, be in a position to buy the most amount of stock, or to sell the option later at a profit. I'll get more into options as buying and selling the same option and never owning the stock. Okay, so the other thing about an option that's very, very important to understand is that the value of the option is derived from the underlying stock, that is the stock upon which the option is written. So therefore, it's sometimes referred to as a derivative because its value is derived from the underlying stock. Therefore, one of the three principles of my strategy is you have to select a good stock or series of stocks to write options on. Principle 2 is you always write options. You rarely, if ever, buy options. You only buy options to close out a position that you've written if the market takes a huge turn. And then when I say huge, it's got to make a turn of 20% in that given stock, and that's very rare. And the third thing is that you've got to be prepared to own stock for brief periods of time. So therefore, that's another reason you want to pick a good one. And when I say a good stock, preferably it's one that has a good dividend, so that during the period of time, because the dividend that you could draw during the time you hold the stock adds to your return on investment. More later. Okay, I keep struggling with how to best convey the whole thing with options. Life is all about options. At any rate, if you saw a movie called Trading Places with Eddie Murphy, there's a scene in that movie where they've taken Eddie Murphy, who was just a bum off the street, and they're trying to train him to be a broker, and they're explaining to him about futures, commodities, and they're showing him about gold and orange juice and whatnot. And so he's watching this intently and listening, and then suddenly one of the partners of the firm says, Mortimer, tell him the good part. And Mortimer says, well, then the good part is we make money whether the customer makes money or loses money. And Eddie Murphy says, you guys are bookies. If you haven't seen that movie, that scene alone is worth watching. Perhaps the best way to describe options is that options is very much like insurance. Now, like insurance, who makes the money? Is it the people buying the insurance policy and giving their money for the insurance, or the people who write the policy? So that doesn't really take too much thought. I mean, you look at Geico, or you look at Allstate, or you look at any of the insurance companies, and they do pretty well for themselves. So if you wanted to go into the insurance business, that is it requires a huge amount of capital and startup cost to do that. Plus, you got to really know what you're doing. So options is the poor man writing options. Let's be very clear about this. We're talking about writing options, which is equivalent to selling an insurance policy. Writing options is the poor man's insurance business. And so to put it in plain numbers, we're looking for return on investment in anywhere from 10 to 30%, which ain't shabby. Now, there is some risk because, like I said, the value is derived from the underlying stock. So if the stock market goes in the toilet, you're going to have some downside risk, although it's not as bad as owning the stock itself. And you'll learn more about that as we go along. In writing options, you protect yourself from the worst extremes of the market both directions, which means if the market goes down, you're not hurt as bad as the guy holding the stock. If it goes way up, you're not gaining as much as the guy that owns the stock. So what we're really aiming for is this golden area of a return on investment of 10 to 30%, which ain't shabby, let me tell you. So think of yourself as being an insurance company. Now, depending on your experience with stocks and investment, as you come across a particular video clip, some of it may just go, right over your head. Don't get discouraged. Go ahead and view that and then go to the next clip. You may find that some information that you learn in a following video clip will make the previous one make sense. And one reason for having them named in such a way that maybe you can see which clip pertained to what is so that you can go back and review a clip if you need to clarify a point. So hang in there, don't get discouraged. Trust me, if you can stand the risk of the stock market at all, this is the way you need to go for the most return for the least risk. So it's worth having some patience here. Okay, I guess it's worth telling you how I got into stock options. I've been investing in stocks for 10 or 15 years, and I get hammered every time there's a recession. So what I've discovered that over a long period of time, just buying and holding stock is about as fruitful as speculating in real estate. So the advent of the internet and cheap computing power has brought about the ability to trade in stock options with very low commissions. And having a very, very low commission is extremely important, because with stock options you're dealing with pennies on a stock for a very short period of time. So you're doing a lot of trading. If you have high commissions, then you'll make a lot of money for the broker, but you won't make much for yourself. To put that in perspective, I first started option trading in my TD Ameritrade account, and they just ate me alive on commissions. So it was a useful it was training wheels. It was a way for me to learn the options business, but it's not a brokerage that you can use for high volume trading. Now I use optionshouse.com, which is an online brokerage, as they all are, and they have $2.99 stock trade commission, and on options you can do up to 5 options or contracts on an option trade for $5. So that's certainly a necessary element. Now remember, our goal is income, not capital gains, or the gain, the share price of the stock, which is very unpredictable, moves up, moves down. We just want the steady income, more the better, and options is the ticket for that. Now, as to the type of account, you will open a cash account as opposed to a margin account. A margin account allows you to do trading on credit, but that's very risky, because if the trades go against you, it could result in a margin call, and then you either got to put up more money immediately, or they close out your positions and get wiped out. So cash account. Okay, so we're all about writing options as opposed to buying options. Therefore, there are 2 ways to write options. If you have a cash account, which is what I would recommend, as opposed to a margin account, then you must write what is called covered options. This means that if you write a put, and I'll get more into what a put is later, if you write a put, then let's say the striking price is $5, and all contracts are in 100 share batches or lots. That's a contract. One contract's 100 shares. So let's say that the stock, you're selling a put with a $5 striking price, which means the person buying the put has the option to put that stock on you at $5. So what he's betting is that the market is going down, so he can put the stock on you at a price above the market value. So you have to set aside, or the broker does it for you automatically, and you have to have enough cash in your account to do this trade. At a $5 striking price, 100 shares, one contract, the broker will encumber or put a hold on $500 of your money that's in your account. Now the money is still in your account, and you still draw the tiny, tiny money market interest. So it's still your money. But it's reserved there so that if the person puts that stock on you at $5 a share, you have the $500 necessary to buy the stock. Now, at the same time, when you sell the option, you get what is called a premium. And this is what we're all into this for, is to get the premium is your money. That's the cha-ching, 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 cha-ching part about options trading. or selling options. That money you receive immediately, right up front. Whether the option is ever exercised or not, you get that money right up front. So therefore, that goes into your cash balance, into your account. And one other interesting statistic I'll throw out to you at this time, because this is probably what makes this whole engine profitable as a writer of options, is that statistically 80% of all the options ever written expire without being called. That is, you've collected your premium at the end of the expiration date. When it's not exercised, the money that was encumbered or being held is released so that you can write another option. So, and options are typically a month long or shorter, although you can do what's called leaps, go out for multiple years, but those are not what I'm into. Okay, so to reiterate, we are writing covered options. Okay, as I indicated before, there are basically two types of options, puts and calls. So an easy way to remember which is which, a put means that as the writer of an option, you are selling someone an option to put the stock on you. Technically it's called to assign the stock, but to put the stock on you at the striking price. Of course, the person buying the option from you is buying it for insurance or speculation to protect himself or to gain from the falling market. So he has the right to put that stock on you at the striking price, and he would never do that unless the stock price at the time of expiration has dropped below the striking price. If it's the striking price or above, then it's not in the money, which is a phrase you're going to hear repeated a lot, in the money. It's not in the money, so therefore he's just simply going to let the option expire without being exercised, which means, remember, you got your premium right up front, and so now you get your funds that were encumbered by selling that put released, so that you can, the following Monday, the options always expire on the third Friday of each month. So the following Monday, that money is available for you to write more options and collect more premiums to ching, 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 and repeat the cycle over and over and over and over again. Now, the other type of option is called a call. This means that you are selling somebody the option to call away or to buy the stock that you hold in your account at a agreed upon striking price. So for you to write a call, you must actually own the stock, and it must be in your broker account and totally unencumbered by another for anything else. In other words, you own it free and clear. So with this, you sell the call option, and for this you receive a premium. Cha-ching, 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 and you still own the stock until and if the option is exercised. You still own the stock, which means if a dividend is declared during the time you own the stock, then you will receive that dividend even if it's called away. That is, if people buy the stock from you at the striking price. So that's an added bonus. For example, as I mentioned earlier, you want to select stocks that have a dividend, and as long as the company is a good, solid blue chip company, like a Philip Morris or Lilly or Johnson & Johnson, or just the hundreds of really blue chip companies. Blue chip meaning that they got a lot of money on their balance sheet, they're not in debt, and that they pay a dividend and have paid a dividend for a long time. capable of paying that dividend in the future. So you've earned the money on the premium, and if a dividend is declared while you actually own the stock, you receive that dividend. Even if it's called away, you'll still receive the dividend if it was declared on your watch. So it's just another bonus. So if it's called away, that is, if the stock value goes above the striking price, then that option is considered in the money. In other words, the person is better off to buy the stock from you at the lower striking price, because the difference between the striking price and the current selling price of the stock is his gain. In which case your stock is gone, but you of course got the money based on the striking price. Let's get back to that earlier illustration of a $5 striking price. So if the stock went to $5.10 by the stock option expiration date, then that stock is going to get called away from you, but instead of getting the market value of $5.10, you're going to get $5. Of course, you got your premium earlier and any dividends that may have accrued while you held it. So that's the way it works.